So what I wanted to just show you was that we just got back from America, and I wanted to share with you just some of the newspaper reports that we found when we were actually on the ground in terms of what was happening there. The first one is that the Dow closed above 15,000, which was the first time it ever did it. I know it's retracted a bit now on the Fed statements, but again, this article is all in there. But it basically said the Dow Jones Industrial Average closed above 15,000 for the first time on Tuesday. This was the beginning of May when we were there. And continued a historic 4-year run as investors are finding the returns increasingly irresistible. That concerns me. The next one is about Bernanke. This came out on the 20th of June, so a couple of days ago. The Federal Reserve Chairperson Ben Bernanke said on Wednesday the US economy is expanding strongly enough for the central bank to begin slowing the process of its bond buying stimulus later this year. He also said that policymakers expect inflation to move back upward toward the long-term 2% goal. The Fed's willingness to dial back on the amount of stimulus it's pumping into the economy reflects the growing confidence in the sustainability and strength of the economy and the recovery. Since cutting interest rates to near zero in late 2008, the central bank has more than tripled its balance sheet to 3.3 trillion to drive borrowing costs down and spur hiring. And interesting enough, the S&P rating agency has just increased America from risky to stable, basically. The committee sees the downside risks to the outlook for the economy and the labor market as having diminished since the fall. It doesn't see rates rising until 2015. They forecast that the US economic growth of between 3% and 3.5% next year and 2.9 to 3.6% in 2015. So that just gives you an idea in terms of the market and what we found on the ground from an economic perspective. Then for me, what we found in terms of the property market, I wanted to show you a video quickly, and then I'll run through some of the newspaper articles. But I think this video by John Chin sums up what I'm trying to say.
Hey Diggers, Chinny here. I have a quick update for you. Just want to kind of bring you behind the curtain on a phone call I just had with one of my close friends who's been in real estate for a very long time. He underwrites a lot of the deals that these institutional buyers are picking up. Basically, he takes like a grouping of single-family homes that have been packaged that are cash flowing. He analyzes those before they'll buy them. And we were talking about what's happening in the markets now, or what we call these peripheral markets. There's a distinction or a difference between a trophy market and a peripheral market. I'll define the two. The trophy markets are the markets that a lot of they have national demand and international appeal. So they're your markets like your Orlando's, Miami, Fort Lauderdale, your Las Vegas, your Phoenixes, your Palm Springs. Those are what we call trophy markets. The trophy markets are like some of the worst places to invest right now. I mean, you obviously have little pockets where you can find deals, but if you're doing any kind of volume and you're financially driven, you're looking for financial performance, growth, safety, and yield, then those are very difficult markets to play in. So you see now a lot of us playing in what we call the peripheral markets. The peripheral markets are lesser known markets. The Memphis, Tennessees, your Charlotte, your Atlanta, Georgias, your St. Louis, your Indianapolis, your Pittsburghs. These markets are less known, but better performing markets in a lot of cases, because you have a lot of times better economic fundamentals. You have prices that are relatively lower compared to the local rents. You might even have higher incomes compared to local prices, so you have a lot more growth potential, basically a softer ceiling for price, but a very hard floor. So in these peripheral markets, here's what's happening right now. You have those institutional investors playing in the trophy markets first. They pick those things apart. You're talking companies and groups with billions of dollars that are buying single-family homes. They're driving the prices up. They're squeezing those yields because the rents aren't going up as fast as the prices are. And then they exit those markets when they can't meet their yield requirements because they're completely yield-driven. So now they're in these peripheral markets, and they're playing with the mom-and-pop real estate investors like you and me, and they're pushing us out of the picture because they're coming in and overpaying for houses because they don't care that the 3 houses on the street sold for $10, $15, $20, $30,000 more than the one they're buying, or I'm sorry, less than the one they're buying, because as long as they can buy that house and put the rehab money into it, get into the hands of a property manager and meet their yield requirement, they're picking that house up. And so they're putting a lot of pressure on the property prices. The property prices are going up, and the rents, again, we're starting to see this happening in these peripheral markets now. The rents aren't keeping up the purchase prices. So what's happening is, here's the interesting phenomenon. They are driving the prices up so much now on the resale inventory. Remember, in the end of 2009, beginning 2010 through parts of 2011, you had a lot of inventory in a lot of these markets. It's all been depleted now. Sometimes in cases where you have like 14 months of supply down to maybe in the Atlanta market right now, we have about 6 weeks of inventory for the stuff that we're looking at. It's hyper competitive. Properties are selling for a lot more than they're being listed for, multiple offer situations all over the place, short sales, bank-owned properties, even at the courthouse auctions. It's hyper competitive because we're playing with these billion-dollar firms. So what's happening is all of the land that was out there that builders stopped building on back in 2007, 2008, these builders, you have to keep in mind, have been very inactive the last few years because you had so much resale inventory at a low cost per square foot compared to what they could build and put a house out there for brand new and make a profit on. So they've been inactive because they can't make money with all that resale inventory. Well, now that resale inventory is gone, and those resale price per foot has been raised up to where the new construction, a builder can come out of the ground and know that they can sell these properties very quickly to end buyers, or in some cases even these institutions that are willing to contract these houses before a shovel even goes into the ground. So with that being said, the opportunity now is to get a house, a brand new construction house, that is only maybe $10,000 to $15,000 more than its resale equivalent, but it's in completely perfect shape and has a lot of times a builder warranty in place, so you have a lot less headaches as far as maintenance goes, and they yield just as strong, if not stronger, than that resale inventory. So you're going to see me play with more new construction now because we have the same yields and we have lower maintenance and a lot less risk with those types of properties, and in a lot of cases we can get them in nicer neighborhoods. So I just want to kind of share that with you, give you kind of a feel for what's happening in the climate in these peripheral markets if you're a cash flow residential investor, and hopefully as I uncover and continue to validate some things with these emerging markets, I'll be bringing those to you, and a lot of times you can see those with new construction inventory because the resales in there just don't make sense to try to fight for. We'll end up doing a lot better on the growth side and on our yields if we're playing with the newer product. So I just want to kind of give you an update on the climate here. I'll catch up with you real soon as I continue to get more feeds like that.
So John sent that out, I think, the end of last week. So it's literally, it's a couple of days old in terms of what's happening. Now, just my interest, who's met John here personally? I know a couple of you guys. Okay, what are your guys' thoughts on him as a person in terms of his investigation, his ability, etc., etc.? Yeah, you agree? Yeah, so dynamic, top of his game. I mean, would you agree that he's the right type of guy for us to have as our guy on the ground? Little bit, actually. He's China. He tells a funny joke that the very first time he met a South African, the guy came up to him and said, "How's it, China?" And he was like, "She's this like some bloody racist." It's just the usual South African slang. So. No, but just some things that we picked up when we were there, and I'm sure Tony and Peter and the guys that were with us now in May. These were actually articles that we picked up literally from the newspapers when we were there. One of them, it's all in your USB survey. Over 50% of Americans expect the home prices to rise. More than half Americans now expect the country home prices to climb within the next year, illustrating a growing optimism towards the health of the housing industry. Crossing the 50% threshold marks a significant milestone, as most Americans believe the housing recovery is truly occurring throughout the country. Considering they've got 300 million, not necessarily highly educated people, but certainly more educated than we've got, I think it's quite important to understand that sentiment has now shifted quite dramatically in the right direction. The other one that's very important is that the funds see an opportunity in real estate. I think this one I'm not going to read in too much detail, but you really need to understand the impact that the funds are having. The third one is that US home builders confidence soars to a 7-year high, which is very much what John was talking about there. For the first time in 7 years, most US home builders are optimistic about home sales, a sign that construction could help drive stronger economic growth in the coming months. The housing recovery is looking more sustainable and should continue to boost economic growth this year, offsetting some of the drag from higher taxes and federal spending cuts. Steady hiring and low mortgage rates have encouraged people to buy homes. The increased demand, along with tight supply of homes for sale, has pushed the home prices. And then this one here is that the recent research is that the property market is now up over 10% for the last year, which is the best increase it's had in nearly 7 years. The rebound in house prices is heavily driven by the western states. 8 of the top 10 appreciating markets is in California, with Phoenix and Las Vegas rounding out the list. And then lastly, there's one actually here, because for me it's not all about being positive, it's also about being negative, keeping your feet on the ground. I know when Peter was there, he went with the attitude of understanding what's happening and trying to punch holes in the story, if you want to call it that, which I think any wise investor should be doing all the time. You know, it's never always good. So there's an article that I've got here about signs of a new housing bubble in several areas. Only a year after the US housing market hit bottom, it may be bubbling again. Odd as it may seem, some economics warn the steady rise in house prices, at least in some markets. However, when you go on to read about it, it talks about all the areas that they're worried about from a bubble perspective are the ones in California, Los Angeles, Phoenix, and Las Vegas. So all the top 10 that I just said had the highest rises are also the ones, which ties back to what John Chin was saying, because that's where the big funds have gone in, that's where the trophy markets are, that's where the international investors have bought up first in terms of where we're actually at.